It's kind of funny, but when you watch a horror movie, the scariest part usually isn't even the monster itself.
Right. I mean, the monster is just the threat. The real terror is watching the characters make just completely terrible, irrational decisions.
Exactly. Like they run up the stairs instead of just going out the front door. They drop their car keys, or they decide to split up in the dark.
Oh, yeah, and you're just sitting there in the audience screaming at the screen like, what are you doing? The exit is right there.
You have to look at the map. But the thing is, from the outside, when you're completely stripped of that blinding in-the-moment terror, well, the logical path is completely obvious.
It is. But fear, adrenaline and stress, they fundamentally rewire how the human brain makes decisions. Your prefrontal cortex, which is the logical part of your brain, basically just shuts down.
Wow. So you just stop thinking.
Yeah, exactly. The amygdala takes over, you stop analyzing, and you just react to the immediate threat.
Which, honestly, brings us directly to the crypto markets. So welcome to another Bitcoin Deep Dive, brought to you by My Crypto Paradise. We're really glad you're here.
Absolutely. And today, we're actually doing something a little bit different, aren't we?
We are, yeah. We're taking the latest, highly technical market playbook from our very own Paradise Team elite trader, Simon, and we're stripping away all the complex charts for a minute.
Because we really want to look at the psychological engine that's driving every single tick on that screen.
Right. If you're tuning in today, you're part of the Paradise family now. And that means we don't just look at what the price is doing, we look at the behavioral science behind why it's doing it.
It's such a crucial shift in perspective, really, for anyone who wants to survive in this space long term. You have to realize that the market, well, it isn't a math problem to be solved.
No, it's more like a massive, unforgiving mirror, right?
Yeah, exactly. And what's truly fascinating about Simon's approach is how he uses technical analysis, not to predict the future like some magic crystal ball, but to map out the current emotional state of the herd.
Right, the herd psychology. So let's unpack this a bit. To understand how to control our own impulses, I guess we first have to understand the natural rhythm of the market that Simon describes.
Yeah, and he uses this brilliant analogy. He says the market is like a living, breathing organism. It has to breathe in and it has to breathe out.
Okay, so the breathe-in phase, that's what he calls motive or impulse waves.
Right, those big, explosive, high-volume moves. But an organism simply cannot continuously inhale forever. Eventually, it has to breathe out, which is the corrective or consolidation phase.
Which brings us to right now, because if you look at the recent price action, Bitcoin took a pretty massive drop, right? From the $74,000 high all the way down to a heavy support zone at $69,000.
Right, and that drop, that was a massive inhale of volume and volatility. So naturally, right now, the organism is in an exhale phase. Simon structurally identifies this as a fourth wave consolidation.
Okay, so how does this exhale visually play out on the charts? Because he mapped out a couple of different ways it could go.
He did, yeah. One potential option is a contracting triangle.
And just for anyone trying to visualize this while listening, a contracting triangle means the price is making lower highs and higher lows, right? Like it's compressing tighter and tighter.
Exactly. It's like a coiled spring. And we should probably explain the psychology of why a triangle even forms in the first place, because it's not just random geometry.
Right. It's human emotion.
Exactly. It happens because the market is coming to a temporary equilibrium that's basically built entirely on anxiety. The sellers are anxious to get out, so they keep lowering their asking price.
Which creates those lower highs.
Yep. But at the same time, the buyers are eager to get in on the dip, right? So they keep raising their bids, which creates the higher lows.
Wow. Okay, so the tension just builds and builds.
Until one side eventually exhausts its capital and you get a violent breakout. But Simon also noted it could play out as a flat pattern, which actually has this deceptive little inhale built right into it.
Oh, right. Where it could temporarily squeeze the price back up to around, I think he said $73,600 before the structural trend resumes back to the downside.
Yeah, and he mentioned that 73,600 mark is highly critical because it confluences with what we call volume profiles.
Okay, let's pause there. Because for anyone who isn't staring at advanced charting software all day long, what does a volume profile actually show us?
Well, a volume profile is essentially a histogram on the side of your chart. It shows you exactly where the most trading activity occurred at specific price levels, rather than just at specific times.
Okay, so it's about price, not time.
Right. So if you see a massive spike in the volume profile right at 73,600, it tells you that a huge amount of Bitcoin changed hands at that exact price.
And psychologically, what does that mean? Just a lot of baggage.
Exactly. Heavy, heavy baggage. People who bought at that level and then had to watch the price drop are now completely underwater. So the moment the price gets back up to their entry point, what are they going to do?
They're going to sell immediately just to break even and stop feeling so anxious.
Bingo. And that reaction creates massive overhead resistance.
That makes perfect sense. So the exact geometric shape of the pattern is really less important than how people are reacting to it.
Yeah, exactly.
This whole exhale phase, this choppy consolidation, it feels like this is exactly where the gambling mindset takes over and just destroys portfolios.
I was thinking about it like scuba diving.
Scuba diving? How so?
No, imagine you're underwater, right? Amateur traders see this exhale, this period where the price is just chopping sideways, and they panic. They feel like they're losing momentum, so they just start thrashing around.
Oh, I love that analogy. Yeah. And that thrashing is exactly what bleeds retail traders dry.
Right, because they can't just sit still. Exactly.
Yeah.
Mechanically, on an exchange, that thrashing means a trader sees a tiny 5-minute green candle, and they just market buy into it. They end up paying the highest possible spread and exchange fees.
And then, of course, the price immediately chops back down.
Yeah. They get scared, their stop loss gets hit, or they panic sell at a loss. Then they immediately reverse their position and open a short, only for the price to chop right back up again.
Oh, man, just getting whipped around.
Right. Every single thrash incurs trading fees, slippage, and a direct loss of capital. They are literally drowning themselves by burning through their oxygen, which is their capital, simply because they can't just sit still.
They completely lack the patience to just float and let the market breathe.
In behavioral science, there's actually a name for this. It's known as action bias.
Action bias, what is that exactly?
It's this deep-seated evolutionary itch that tells your brain, I must be doing something active to be making progress.
Ah, right. So in trading, that translates to feeling like you have to be in a trade all the time to be a real trader.
Exactly. But these wave patterns Simon uses, they work precisely because they visually map out this exact human impatience. The herd gets bored, the herd thrashes, and ultimately the herd gets liquidated.
Wow. Well, the professional mindset, the My Crypto Paradise ethos, recognizes that doing absolutely nothing during the exhale is actually an active choice.
It's a highly profitable choice. Sitting on your hands is a position. You are preserving your capital while everyone else is paying the market a heavy tax for their own impatience.
Right. Simon is just waiting for the structure to actually finish before he even considers making a move. So if the market is an organism taking a breath, I guess macroeconomic factors are kind of like the air pressure in the room, right?
Yeah, great way to put it.
To understand when to finally act, we really have to look at the larger forces putting pressure on that organism. And Simon points out some massive flashing macro crisis signals right now.
He really does. The macro picture is incredibly tense.
Yeah, he highlights that the United Kingdom's 10-year government bond yield recently crossed 5% for the first time since 2008.
And we have to pause on that because that 5% threshold is a massive psychological and financial barrier.
Really? Why is 5% such a magic number?
Well, think of capital like water, right?
Yeah.
It always flows to the path of least resistance and the highest reliable yield.
Okay, makes sense.
So when a massive, stable entity like the UK government is offering a guaranteed 5% return on investment, institutional capital naturally drains out of highly volatile, risk-on assets like crypto.
And it just flows right into those safe bonds.
Exactly. It literally sucks the liquid oxygen right out of the crypto market.
Wow. And simultaneously, Simon points out that Europe is bracing for another severe wave of inflation, driven by this worsening energy crisis and broader geopolitical conflicts.
Right.
But, a retail crypto trader sitting at home might ask, why do I care about European energy bills? I'm trading Bitcoin.
Well, you care because it directly impacts the physical foundation of Bitcoin, which is the miners. Mining, it takes massive, massive amounts of electricity.
It does. And the mechanics of a mining operation actually make them incredibly vulnerable to this specific kind of macro environment, don't they?
Completely vulnerable. Think about a commercial Bitcoin miner. Their operating costs. The electricity to run thousands of ASIC machines, the rent for cooling warehouses, the payroll, all of that is priced in fiat currency.
Right. They pay their bills in dollars or euros.
Exactly. But their revenue is generated entirely in Bitcoin.
Oh, I see where this is going.
Right. So when the price of Bitcoin drops, but the cost of energy spikes, their profit margin instantly inverts. Suddenly they are paying more to mine a Bitcoin than that Bitcoin is actually worth on the open market.
Which leads right into Simon's observation that Bitcoin mining difficulty is currently in a free fall. And he points out we saw this exact same structural indicator play out in the 2018 bear market and again in 2022.
Yeah, historical context is vital here. In both of those bear markets, when that profit margin inverted, smaller, over-leveraged mining operations just couldn't afford to keep the lights on anymore.
Right, we saw what are called hash ribbon inversions.
Exactly. These miners are forced to unplug their machines, but even worse, they're forced to liquidate their accumulated Bitcoin treasuries onto the open market just to pay off their fiat debt or to cover severance packages for their staff.
Wow, so they just flood the market with sell orders out of pure desperation. They basically capitulate.
They do.
And Simon maps out a historical capitulation zone for the current cycle, sitting right between $44,000 and $55,000. He argues the macro pressure is going to force the price down there to trigger that exact same minor capitulation.
That's his thesis, yeah, based on the structural data.
But I have to play devil's advocate here for a second. Let's look at the immediate board. Simon also noted there is a massive $100 million buy wall sitting right at $65,500.
Right. Clearly, some smart money whale is actively defending that level.
Exactly. So if a listener sees that massive buy wall, but they also hear Simon say the macro data points toward an ultimate capitulation bottom at 44,000, why shouldn't that trader just take out a massive, highly leveraged short right this second and wait for 44K?
Oh, that is such a dangerous game.
Why not just front run the inevitable?
Because the market can remain irrational much, much longer than a gambler can remain solvent. Front-running is arguably one of the most dangerous psychological traps in all of trading.
Okay, walk me through what happens then.
Let's play out your scenario. A retail trader says, the macro looks terrible. The miners are going to capitulate, so I'm shorting with 50 times leverage right now.
Makes sense on paper, right?
Sure. But what happens if that whale at 65 decides to market buy, squeezing the price up to, say, $72,000 just to trap early shorters before the real drop happens?
Oh, your position gets completely liquidated.
Exactly. The exchange forcefully closes your trade because you ran out of margin. Your account goes straight to zero. You were fundamentally right about the long-term macro direction, but you still lost every penny because of your timing and leverage.
Man, that is the ultimate penalty of the gambling mindset, isn't it?
It really is. Professionals like Simon, they do not guess. They wait for structural confirmation. They wait for what's known as the exchange of hands.
The exchange of hands. Meaning what exactly?
Well, that capitulation zone at 44,000, it isn't just a random target on a chart. It represents a physical, verifiable event where weak, unprofitable miners are forced to transfer their assets at a massive discount to strong hands and smart money.
Okay. So until the blockchain data actually proves that exchange has occurred, the bottom is not officially in.
Right. Simon lets the impatient traders get chopped up fighting over the middle, and he simply waits comfortably at the destination.
The difference between anticipating the market based on a thesis and waiting for the market to actually confirm your thesis, that is the great divide.
Yeah. It is the only thing that separates the pros from the gamblers.
Which reminds me, I want to bring up a very sobering statistic that Simon dropped in his analysis. It really sets the tone for why the My Crypto Paradise methodology is so rigorous. He states that the vast majority of people lose their entire portfolio within their first 3 years of day trading.
3 years. And you are washed out completely. It's a very well-documented phenomenon.
But why? Is it just because the charts are too complicated?
No, not at all. It's not because retail traders aren't smart enough. It comes down purely to behavioral failures.
Behavioral failures like what?
Well, they use excessive leverage to chase quick riches. They enter trades without a clear structural why, meaning they don't even know if they're playing a multi-month macro trend or just a 15-minute bounce.
Right, they're just guessing.
Exactly.
Yeah.
And crucially, they hold on to losing positions far, far beyond their invalidation point.
Holding the bag. Yeah. Let's dig into this because Simon's personal strategy is literally the exact opposite of that. He says he operates defensively about 80% of the time.
Yes, the 80-20 rule.
Right. He takes tiny 2% paper cuts, or he just exits trades at break even. He protects his downside obsessively so that he can go aggressively big the other 20% of the time when the high probability setups finally align.
And that 80-20 approach is the mathematical hallmark of a true professional. If we look at the raw math of drawdowns, it's pretty scary.
How so?
Well, if you stubbornly hold a losing trade until your portfolio is down 50%, you don't just need a 50% gain to get back to where you started. You need a 100% gain just to break even.
Oh, wow. Yeah. That's a huge hole to dig out of.
It's a mathematical death spiral. Simon's strategy of taking a tiny 2% paper cut ensures he never falls into that trap. Capital preservation must always, always supersede making money.
I was thinking about this trap of holding losing trades, and honestly, to me, it feels like this toxic mix of the sunk cost fallacy and just pure ego.
Oh, absolutely. Ego is the biggest account killer.
It's like, imagine going out to a really expensive, highly rated restaurant, right? The food arrives and it tastes like cardboard.
Right.
The service is completely awful.
But you force yourself to sit there and eat every single bite anyway.
Yes, you suffer through the entire meal just because you already paid for it. You just don't want to admit to your partner or to yourself that it was a mistake to walk through the door. Why is admitting we're wrong so neurologically painful for us?
You're touching on the neuroscience of loss aversion and ego bias. For the gambling mindset, a financial loss isn't just processed as a change in their account balance.
How is it processed then?
It's processed by the brain as a direct personal attack on their intelligence and their worldview.
Wow, really? So it's deeply personal.
Very. Closing a trade in the red means looking in that mirror we talked about earlier and saying, I was wrong and the market was right. That creates severe cognitive dissonance.
So what do they do instead?
They hold the position. Because as long as the position is open, the loss is only on paper. They haven't officially failed yet. They hold on, just praying the market turns around to validate their ego.
And then inevitably, the macro trend takes over and they get completely liquidated.
Exactly. But for a professional trader within the Paradise team, a loss is totally stripped of all emotional weight. It's not an indictment of their intelligence. It's simply a business expense.
Just the cost of doing business.
Right. It's the cost of operating in a probabilistic environment. Simon takes a 2% loss and moves on to the next chart immediately. The amateur is seeking the dopamine hit of being proven right, while the professional is seeking the quiet, boring satisfaction of a steadily growing portfolio.
So to win in this space, you really have to completely rewire how you experience discomfort. You have to step into what I would call the contrarian comfort zone.
Oh, I like that. The contrarian comfort zone. That's a brilliant way to frame it. Simon emphasizes that because the market is literally constructed out of human psychology, doing what feels emotionally comfortable to your human brain will almost always result in you losing money alongside the majority.
So to win, you have to do what is actively, deeply uncomfortable. Can you give me a concrete example of what that actually looks like in practice on the charts today?
Sure. Let's look at the current macro downtrend we've been discussing.
Yeah.
The masses, the retail traders, they're constantly trying to catch falling knives.
Right, trying to predict the exact bottom of every dip.
Exactly, so they can long the market and feel like heroes who bought the absolute lowest tick. Because it feels comfortable to be optimistic, it feels comfortable to buy the dip.
But Simon is doing the exact opposite.
He is. He uses bearish trading tactics during a downtrend. He isn't looking for the bottom. He's focusing strictly on catching the local tops of those little exhales to enter highly calculated short positions.
Ah, so he's catching the exhale to ride the next massive inhale down.
Exactly that. Simon has this great quote in his analysis, says, where your focus is, there flows your energy.
I love that.
Yeah. If you spend all your time trying to catch the bottom in a bear market, you're just fighting the tide. But if you focus on catching tops, you align your energy with the dominant structural trend.
Makes total sense.
He actually ends his report with a mantra that truly encapsulates the Paradise Team ethos. He says, thinking probabilities, not emotions. Losses are feedback. Wins are the result of disciplined execution.
Losses are feedback.
Yeah.
That is incredibly powerful. But, let's get real for a second. How does a listener actually start implementing this?
It's tough, definitely.
Right, like how do you maintain that emotionally detached, robotic precision in your own trading without feeling that gut-wrenching fear of missing out?
The FOMO is real.
We've all been there. You open your app, you see a random coin pumping 20% in an hour, and your brain just screams at you to jump in before you miss the boat.
It is incredibly difficult to rewire those evolutionary impulses in isolation. And honestly, that's exactly why trust and community are paramount.
Like being part of the Paradise family.
Exactly. Being part of the Paradise family isn't just about receiving trade setups, it's about building environmental architecture.
Environmental architecture.
Yeah, you are actively surrounding yourself with seasoned professionals who normalize emotional discipline. When everyone around you is patiently waiting for structural confirmation, patience just naturally becomes your new baseline.
Right. It's the difference between trying to train for the Olympics by yourself in your basement versus going to a gym full of gold medalists. The whole standard of acceptable behavior completely changes.
Exactly. And tactically, to beat that fear of missing out, you have to shift from a deterministic mindset to a probabilistic one.
Okay, what's the difference there?
A deterministic trader looks at the chart and says, I know for a fact Bitcoin is going to 74,000 today, so I must buy right now.
And when it drops instead, their reality is shattered and they panic.
Exactly. But a probabilistic trader, like Simon, looks at the exact same chart and says, based on the volume profile and the wave structure, there's a 60% probability of a drop. If it drops to support, I enter here. If it pushes up to resistance instead, my invalidation level is strictly set right here, and I will gladly take a 2% loss.
Because you have a predefined system for whatever the market decides to do, so there's absolutely no need to panic. The uncertainty is already priced into your strategy.
Precisely. And when you view losses purely as data points, as objective feedback telling you that the market conditions have shifted from your initial thesis, well, you completely neutralize the emotional sting.
You aren't a failure. Your system just gathered new data.
Right. And that emotional detachment is exactly how you survive the 3-year washout period. You survive by ensuring that your inevitable paper cuts never, ever become fatal wounds.
That's brilliant. So bringing all of this together for the listener today, we've really looked at the market not as a static chart, but as a breathing organism, taking in massive inhales of volume and exhaling into these complex, psychologically tense consolidations.
We have. And we've broken down how severe macroeconomic pressures, like soaring bond yields and energy crises, force weak, over-leveraged miners to completely capitulate.
Right, and we've seen how that event historically transfers wealth directly from the impatient to the patient. And perhaps most importantly, we've dissected the ego trap.
Yes, seeing how the deep-seated biological need to be right is the ultimate enemy of actually being profitable.
So really, the ultimate takeaway from Simon's analysis isn't a specific price target at all. It's the realization that all of these technical tools, the wave patterns, the volume profiles, the structural supports, they're ultimately just topographical maps of human emotion.
Absolutely. True financial freedom in the crypto space doesn't come from outsmarting the market because you simply can't control the macro environment.
No, it comes from outsmarting your own human biases, preserving your capital above all else, and executing your plan with the ice-cold patience of a Paradise team professional.
The market is always, always going to provide another opportunity tomorrow. The only question that matters is whether you'll have the discipline to still have capital left to seize it.
Exactly. Which brings us right back to that horror movie we talked about at the very beginning of the deep dive. You don't have to be the character running blindly up the stairs in a panic while everyone screams at the screen.
No, you have the map now.
You have the map, you understand the psychology, you just have to follow it. But I want to leave you with a final lingering question to ponder long after this audio stops playing. We've established today that financial markets are really just a giant, unforgiving mirror, reflecting our own human impatience and our own fragile egos right back at us in real time. So if that's true on the charts, where else in your life are you stubbornly holding on to a losing trade simply because you're too afraid to admit you were wrong?